As of August 3rd, 2026, something decisive has shifted beneath the surface of the bond market. Real yield momentum has turned lower after months of relentless ascent, and the US dollar is beginning to soften at the margins. Mainstream coverage frames this as routine volatility. Institutional data suggests otherwise. Serious observers recognize inflection points when multiple macro signals reverse simultaneously. This is one of those moments. Let's establish what we know. We know that the US 10-year real yield has rolled over during the past 60 days, according to Treasury data, marking a clear loss of upside momentum after a prolonged tightening cycle. We know central banks remained net buyers of gold in the second quarter of 2026, as reported by the World Gold Council, extending a multi-year accumulation trend. We also know that silver ETF positioning, based on 2026 Bloomberg flow data, remains historically light relative to prior price expansions. The interpretation is straightforward. Monetary pressure is easing at the margin while institutional accumulation persists. The stakes are significant. Structural repricing phases begin quietly, not with headlines. We will move step by step: macro, policy, institutional behavior, physical market dynamics, and finally positioning. Now let's examine the first fracture. Fracture number 1 is the shift in real yield momentum. In July 2026, U.S. Treasury data shows the 10-year inflation-adjusted yield retreating from its recent peak, breaking a sequence of higher highs that defined the prior tightening phase. At the same time, CME FedWatch probabilities began pricing incremental easing over the next 2 policy meetings. The latest core PCE release from the Bureau of Economic Analysis confirmed continued disinflationary drift on a 3-month annualized basis. This is critical. Precious metals do not respond primarily to the absolute level of real rates. They respond to the direction of change. When real yields stop rising and begin to roll over, the pressure gradient that suppresses gold and silver weakens. We observed similar pivot behavior in late 2007 and again in mid-2019, both periods preceding sustained metals appreciation. The implication is not immediate breakout, but early-stage repricing potential. Momentum has shifted. Before the headlines adjust, markets begin recalibrating. But rate direction isn't the only reversal. Fracture number 2 sits beneath the rate market itself: Treasury supply and liquidity stress. The July 2026 U.S. Treasury quarterly refunding statement outlined elevated issuance across the curve, with particular expansion in longer-dated maturities. Simultaneously, the Congressional Budget Office's 2026 update revised deficit projections higher, extending structurally large funding needs well beyond the current fiscal year. Federal Reserve data on primary dealer balance sheets shows increased absorption requirements, with bid-to-cover ratios stabilizing only as yields rose to attract demand. Here is the constraint. Expanding debt supply places upward pressure on long-end yields, but persistently high yields increase fiscal servicing costs and tighten financial conditions. That feedback loop limits how restrictive policy can remain before growth deteriorates. In 2020, a similar tension between issuance and market absorption preceded aggressive liquidity injections and balance sheet expansion. The implication is subtle but consequential. The probability of monetary accommodation rises when debt dynamics strain the system. Precious metals historically respond to that inflection before policy announcements formalize it. Stay with me. Fracture number 3 is currency. In July 2026, the ICE dollar index registered a loss of upward momentum, failing to sustain prior highs and breaking short-term trend support. The Bank for International Settlements Q2 2026 trade-weighted dollar index shows similar flattening across a broader basket, reducing the argument that dollar strength is universally intact. Meanwhile, IMF data indicates stabilization across several major emerging market currencies after prolonged depreciation pressure. This combination suggests dollar exhaustion rather than renewed acceleration. For precious metals, the dollar is not merely a pricing denominator, it is the transmission mechanism of global liquidity conditions. When the dollar peaks and begins to soften, capital flows recalibrate. We saw this dynamic clearly between 2002 and 2003, when a topping dollar preceded one of the most sustained gold advances in modern history. A weakening dollar provides a tailwind for commodities broadly and monetary metals specifically. The surface narrative may call this consolidation. Structural reality may call it transition. This is where it becomes serious. Fracture number 4 concerns official sector behavior globally. The World Gold Council reported continued net purchases by central banks in the second quarter of 2026, maintaining a pace consistent with the record-setting prior year. People's Bank of China monthly disclosures for June 2026 confirmed additional gold additions to reserves. extending a transparent accumulation streak that defies Western expectations. International Monetary Fund IFS database updates show similar reserve composition shifts in Turkey and India, systematically reducing dollar-denominated asset weightings within sovereign portfolios. Official rhetoric often emphasizes stability and existing reserve adequacy during current public forums. Institutional actions demonstrate diversification away from single currency exposure, regardless of their public commentary. This divergence between public statements and balance sheet adjustments is not new in monetary history. We observed comparable behavior during the 1960s reserve diversification cycle when trusted assets were accumulated ahead of major monetary regime changes. The implication is a structural floor under gold prices. When sovereign buyers absorb supply regardless of price spikes, volatility diminishes very significantly on the downside. This creates a baseline valuation support that private markets must eventually recognize as permanent. The signal is not speculative. It is strategic national policy. These actors are not trading for profit. They are securing sovereignty against counterparty risk. This creates a bid absent in paper markets, and silver does not trade in isolation. Fracture number 5 shifts from monetary demand to industrial reality. The Silver Institute's 2026 interim report projects sustained fabrication demand, particularly from photovoltaics and electronics, even amid uneven global growth. International Energy Agency data for the second quarter of 2026 confirms continued solar capacity expansion, with installation rates running above prior year levels despite tighter financing conditions. S&P Global's July 2026 PMI releases indicate stabilization in global manufacturing after earlier contraction signals. This matters because silver is not purely a monetary metal. It sits at the intersection of capital preservation and industrial utility. When manufacturing activity stabilizes while monetary conditions begin easing, silver acquires a dual tailwind. We witnessed this configuration in 2010 and 2011 when recovering industrial demand amplified an already supportive monetary backdrop. The implication is the formation of an industrial floor beneath price volatility. Even if speculative flows hesitate, baseline consumption absorbs supply. Monetary upside layered atop industrial stability creates asymmetry. Pay close attention. Fracture number 6 focuses on market structure. CME Group data from July 2026 shows COMEX registered silver inventories remaining compressed relative to prior multi-year averages despite periodic inflows. The latest LBMA monthly report indicates London Vault holdings stabilizing but not expanding materially. At the same time, intermittent backwardation episodes have appeared in short-dated contracts, signaling localized tightness in deliverable supply. This does not imply imminent shortage. It does highlight leverage. Paper claims on silver vastly exceed immediately deliverable inventory, a structural feature of futures markets. When sentiment turns constructive, that leverage can amplify price movement disproportionately. We observed similar dynamics during 2020 when physical demand spikes collided with constrained logistics, producing rapid repricing. The implication is volatility asymmetry. Downside moves occur gradually under hedging pressure. Upside adjustments can unfold rapidly when physical availability tightens against rising demand. The surface narrative calls inventories adequate. Structural analysis suggests limited margin for demand shocks, but positioning may be the most important fracture. Fracture number 7 is positioning. CFTC, Commitment of Traders data from July 2026, shows speculative long positions in silver futures well below historical peaks. Bloomberg ETF flow data confirms that silver-backed exchange-traded products have not attracted the magnitude of inflows typically associated with euphoric phases. U.S. Mint silver coin sales year-to-date remain subdued relative to prior decade averages. The interpretation is unambiguous. There is no euphoria. There is no mania. Investors are not chasing. Sentiment allocation towards silver remains historically light. This matters because positioning determines the fuel available for price acceleration. Reversals from crowded positions exhaust quickly. Reversals from underweight positions can sustain extended moves as capital reallocates. The current posture suggests significant capacity for buying if the macro thesis continues strengthening. The narrative may talk about silver as if it has already run. The data says otherwise. This is not a crowded trade. Now let's address the bear case directly. Real yields, while rolling over in momentum terms, remain positive in absolute terms, according to current U.S. Treasury data. Positive real rates historically compete with non-yielding assets like gold and silver. The IMF's 2026 World Economic Outlook warns that if global growth weakens materially, capital could rotate back into the US dollar as a relative safe haven, reversing recent softness. The OECD's latest forecasts highlight downside risks to industrial production, which would directly affect silver's fabrication demand. Bloomberg flow data confirms ETF inflows remain muted, signaling limited institutional urgency. Meanwhile, S&P 500 performance remains resilient, reinforcing a risk-on environment that reduces immediate demand for defensive assets. The bear case is real. I am not softening it. Structural transitions are rarely linear, and metals can underperform if disinflation accelerates into outright contraction. But now consider the full data set. 10-year real yields have declined from their recent July highs, U.S. Treasury data. The Federal Reserve balance sheet remains above $7 trillion, latest H.4.1 release. Quarterly Treasury issuance exceeds prior year levels, July 2026 refunding statement. Central banks posted net gold purchases in Q2 2026, World Gold Council. The PBOC added gold reserves again in June 2026. Turkey and India increased gold allocations, IMFIFS updates. The U.S. deficit remains above 6% of GDP, CBO 2026 estimate. The BIS reports gradual diversification in global reserve composition, Q2 2026. DXY momentum has softened month over month, ICE data. Trade-weighted dollar indices have flattened, BIS. Global PMI readings stabilized in July, S&P Global. CPI year-over-year inflation continues moderating, BLS. Core PCE shows 3-month annualized cooling, BEA. Solar installations remain elevated year-over-year, IEAQ2 data. Silver industrial demand projections remain firm, Silver Institute 2026 interim. COMEX registered silver inventories sit below multi-year averages, CME July data. LBMA vault holdings remain steady, latest monthly report. The gold-silver ratio remains above long-term median levels. Silver ETF holdings remain subdued, Bloomberg 2026 flows. CFTC net speculative length is below prior peaks July report. Taken together, macro momentum, institutional accumulation, and contained positioning intersect with constrained physical buffers. Primary data referenced in this briefing includes releases from the Federal Reserve, including H.4.1 balance sheet statements and primary dealer statistics, U.S. Treasury yield and quarterly refunding data, Bureau of Economic Analysis core PCE reports, Bureau of Labor Statistics CPI data, and Congressional Budget Office fiscal projections. Precious metals statistics were drawn from the World Gold Council quarterly updates, the Silver Institute 2026 interim report, CME Group COMEX inventory data, CFTC commitment of traders reports, and LBMA monthly vault holdings. International context references include IMF World Economic Outlook and IFS databases, Bank for International Settlements Reserve Composition Statistics, OECD growth forecasts, International Energy Agency solar deployment figures, S&P Global PMI releases, and Bloomberg market flow data. All viewers are encouraged to verify each data point directly through the originating institutions. Independent validation is part of disciplined analysis. If real yields continue declining while central banks accumulate and silver inventories remain tight, do you believe we are entering a structural metals repricing or another temporary bounce? I want a precise answer. Comment structural or cyclical and include the country you're watching from. Serious observers compare notes across jurisdictions because monetary shifts are global, not local. The core thesis is simple. A synchronized reversal in real yield momentum and dollar strength combined with persistent sovereign gold accumulation and light silver positioning, creates conditions historically associated with durable upside repricing. If you value institutional data over narrative framing, subscribe. This channel is built for serious observers who prefer primary sources to opinion. These conversations are being suppressed in mainstream coverage because they challenge the surface narrative of stability. Stay disciplined, stay independent. This material is provided for educational purposes only and reflects analysis based on publicly available data at the time of recording. It does not constitute financial investment, legal, or tax advice. I am not a licensed financial advisor, and no part of this presentation should be interpreted as a personalized recommendation to buy, sell, or hold any asset. Financial markets involve risk, including the potential loss of principal. Precious metals can be volatile and may experience significant price fluctuations over short and long time horizons. Past performance does not guarantee future results. Viewers are responsible for conducting their own due diligence, reviewing primary sources, and consulting qualified professionals before making any investment decisions.